So Prakash Pipes. So this is what we are going to cover in today's session. And recently we have recommended this stock. So this is our new recommendation. So in today's session, we'll discuss on Prakash Pipes. So known for PVC pipes and fittings. And of course, they are into flexible packaging as well. So in this particular session, we'll try to check the company's history, its business model, so future growth potential, of course, valuation also. And we'll let you know the rationale behind recommending this stock. So we'll cover basically why we are recommending this stock will be covered in this particular session. So coming to the history part, established in 2017 after being demerged from Prakash Industries. So Prakash Industries has got 4 decades of experience. So Prakash Pipes is a subsidiary of that company, but in 2017 it got demerged. So now Prakash Pipe Limited began as a separate entity in 2017 after the demerger, and they are manufacturing PVC pipes and fittings initially. Over the years, they expanded their product lines, focusing on innovation, sustainability, and of course the packaging segment. And today it's a leader in northern India's PVC pipes industry and has ventured successfully into flexible packaging. So you need to understand, predominantly it's a North Indian company. So they don't have any business in down south. Most of their business is towards the north side of India, and of course we'll check those numbers as well. So coming to the business model, so they are kind of diversified into 2 businesses. One is PVC pipes and fittings, which is 61% of their revenues. Flexible packaging contributes around 39% of their revenues. So what is this PVC, pipes and fittings? So this is where the products include soil, water, rain pipes, plumbing pipes, casing pipes, garden pipes, so on and so forth. And of course, they are selling the pipes and they are also doing the fitting work as well. So they take up the projects. And of course, they have got strong market presence with over 600 dealers and retailers in the north, across North India. Coming to the production capacity, 60,000 metric tons per year. That is their production capacity. Flexible packaging, which is 39%, of course, laminates and barrier films packaging solutions, and they service over 180 customers across all the sectors like food, FMCG, pharmaceuticals. For example, Haldiram's is their customer, Patanjali is their customer, Dabur is one of their customers. Now, looking at these 2 businesses, what you need to understand is PVC pipes and fittings. This is their cash cow, a stable cash cow business. When it comes to flexible packaging, this is their high growth business, which is rapidly expanding. So, and this is high margin business also. PVC pipes is a cyclical business. Slightly cyclicality you will find whenever there is. Of course, we'll discuss this during the valuation, but the fluctuation in the raw material will affect PVC pipe segment. But flexible packaging is more a high margin business. So, and rapidly growing business. So right now the percentage is around 39, but in near future this percentage of contribution might grow. So that is the expectations. And coming to the geographic presence, so like I said, dominant in the North Indian side. So UP and Uttarakhand contributes 54% of revenues. Punjab 28, followed by Haryana 14. Delhi NCR is still in the early stages, only 4%. So like 80% of the business comes from 3 states, UP, Uttarakhand and Punjab. That's where more than 80% of the business is coming from. And of course, they eventually want to grow domestically and want to expand internationally as well, but that is in the future. So obviously first they have to grow in the pan India. Later on they might expand globally also. But as of now, 80% of their business comes from 3 states, UP, Uttarakhand, Punjab. Now what is the future outlook? So they are planning to increase the capacity in flexible packaging from around 20,000 metric tons current capacity to 36,000 metric tons annually. Like I said, this is their high growth business. So of course they are expanding the capacity. So, like I said, right now it is 39% of the business, but in future that percentage will grow. And of course, they are expanding the capacity also and expanding product lines in PVC pipes with the introduction of injection molding machines and new HDPE drum production. So basically, for packaging, they are increasing the capacity. So they want to increase that capacity and volume. Whereas on the PVC side, PVC pipe segment, they are expanding the product line. They are launching new products. Again, growth will come from that segment also. Coming to the challenges and risk. This I have already mentioned briefly. So, volatility in the raw material prices, especially PVC resin, impacting profitability. So, PVC resin is the major raw material for PVC pipes. So, whenever this resin prices fluctuate, go up, comes down, it will definitely impact the profitability of the PVC pipe segment, which is 69% of the 61% of the business. So this is cyclical. So resin prices impact the margins. Remember that. Regulatory risk and competitive pressures in the packaging and pipe industry uh, can also be a challenge for this business going forward. Of course, regulatory risk and competitive pressures are natural in every business and in this business also. Dependence on economic conditions and infrastructure spending trends. Now again, this factor will influence PVC pipe segment significantly. Why? End of the day, it is PVC pipes, irrigation pipes or plumbing pipes and all. That is all related to their PVC segment, and of course, it is cyclical in nature. Economic conditions, infra spend, monsoon, so on and so forth, will the overall economic conditions or government spending, government budgets also will impact their PVC segment. So overall, if you look at the business model, they have PVC pipes, they have flexible packaging. PVC pipes, raw material is also fluctuating. Government spend or economic cycles, infra spending will also influence. So regulatory risk, competitive pressures will also influence. So their PVC pipe segment is slightly cyclical. But coming to their flexible packaging, like let's say Patanjali is their customer, or Haldirams, or let's say Dabur, mostly these are recession proof kind of businesses, not linked with any kind of economic slowdown and all. So Haldiram, you will keep purchasing Haldiram, whatever, FMCG products, whether there is recession or whether there is boom, you don't really mind, right? So packaging side of the business is not really that cyclical, which is rapidly growing and high margin business. So Prakash Pipes. So if you look at the recent, so here you can see, I hope you can see the screen. One second, let me check. So as you can see, look at the top line, that is, look at the revenues of this business from 2019 to 2025. So 300 to around 500 to 700 to 780. So as you can see, there is consistent growth in sales. So sales are growing. But look at the margins. From 2019 to 2023, the margins are mostly stable, averaged around 12%. So 1% here and there, but overall it is pretty stable, not highly cyclical, pretty stable, averaged around 12%. But if you look at 2016 numbers, the margins spiked towards 16%. And that is the peak. Why? Why the margin spiked to from 12% to 16%? What is the reason? And you can check the net profits also from 29 to 47 to 90. So net profits also peaked around 2024. Let's try to understand why margin spiked significantly in 24. There are multiple reasons, but I am just mentioning four major reasons. First is their shift towards higher margin products, which is flexible packaging. So flexible packaging segment, which is by default a higher margins compared to PVC pipes. So their revenue mix changed, product mix changed. So previously PVS pipes was contributing a bigger percentage. Now 39% is coming from flexible packaging. So that percentage is growing since packaging is a high margin product. So overall margins also increased. So revenue contribution from flexible packaging increased significantly, reaching 39%, thereby boosting the overall profitability. That is reason one. And in the near future also this will continue. Why? Because they are increasing the capacity from 20,000 metric tons to 36,000 metric tons. So this segment, which is higher margin segment, contribution will grow in the near future also. And one more thing, okay, that I'll cover in the next slide. So the second reason is operational efficiency or cost management. So basically cost optimization. So increased scale and better utilization of production capacities is one reason. And the other reason is, of course, because of the improved economies of scale, that improved the cost control measures. Efficient inventory management also significantly reduced the production cost. So overall, I would say operating leverage, economies of scale, plant running at full capacity or higher capacity than the past, or controlling cost. And one more thing is inventory management. Of course, all these things helped. So I would put it as operating leverage also helped in increasing the margins. Third is very important, favorable raw material prices in 2024. So decline or stability in the key raw material prices, that is PVC resins and polymers is the other, but PVC resins is the major raw material. So the raw material prices dropped, allowed margins expansion due to reduced input cost. So like I already mentioned, this is this can be cyclical. PVC pipes can be cyclical. So PVC pipe segment, the resin, the raw material, the cost of the raw material dropped significantly. That allowed the company to generate higher margins. Reason number three. Fourth, increased pricing power. So product quality or strong brand positioning, market leadership enabled better pricing, positively impacting the margins. So, but I would say this, being a cyclical company, pricing power and all are very limited. But still, I have mentioned it here, strong brand position, so on and so forth. But if there is weak economic conditions, weak government spend, bad monsoons, so if the overall situation is bad and the raw material prices go up, so PVC pipe segment will face that heat. So increased pricing power and all, since everything is good, this also helped. So fourth reason. But in the downturn, this might not help. The fourth reason might not help. Now comes the most important question. Will these margins sustain or not? That's the most important question to ask. Now, what are of course, it will sustain, few things will sustain, few factors will not sustain. Let's try to understand what will sustain and what will not. Factors supporting the sustainability: increasing contribution from the flexible packaging, which offers consistently higher margins. This we have already discussed. From PVC dominant business, they are slowly moving towards packaging dominant or 50-50, we would say. So that business segment is growing rapidly, which is higher margin segment. So continued investments in that packaging segment will allow them generating a higher margins going forward because of the change in that product mix. So continued investments in operational efficiency and advanced manufacturing process, this also I have covered. They are increasing the capacity, and if the capacity, if they utilize full capacity, of course economic scale will also help in cutting the cost. Strong brand equity and market leadership supporting sustained pricing power. This is mentioned by the management, so I'm mentioning it here. But take this brand or market leader. Of course, market leadership will help in the economies of scale. But brand and the pricing power, take it with a pinch of salt because cyclicality is involved. Now comes to, let's look at the potential risk for the sustainability of the margins. One, raw material volatility. Any sudden increase in the PVC resin or the polymer prices will put a pressure on the margins. Competitive pressure. Increased competition in both segments. It can be pipes or packaging, may limit the pricing power, may limit the margins. Pricing power is nothing but the margins. Economic conditions. A slowdown in the infrastructure or consumer spending could impact sales and margins. So, since they are moving towards the flexible packaging, higher margins can be sustainable to a certain extent. But for that to sustain, PVC should support. Without the support of PVC, that cannot be done. And PVC cannot support fully because PVC by itself is dependent on raw material prices. So you need to understand that. So what is the conclusion? The spike in 2024 margins appears to be driven by strategic shift towards higher margin products, cost efficiencies, and favorable raw material conditions. Shift towards higher margin products will sustain. Cost efficiencies, of course, running at full capacity and all that might also to a certain extent sustain. But favorable raw material conditions will not sustain forever. So that is the cyclical factor here. So margins might moderate slightly. But a considerable part of the improvement from 12 to 16, whatever the improvement happened, a part of that will sustain. Appears to sustain due to strategic product mix and efficiency initiative. Let me repeat that again. And you remember this as long as you are a shareholder of this stock, which is Prakash Pipes. Margins might moderate. So I am clearly mentioning 16% will not sustain. But will it go back to 12%? That is not in our control, of course. My guess is as good as your guess. But in the long run, what I feel is, since they are moving towards the high margin products, from average 12, that percentage can go up. But 16% may not be sustainable. So in the near future, margins will moderate. May not be towards 12%, but at least 13, 14, somewhere it will moderate. Now, so of course, we'll get into the valuation part also. But why now? Let's look at the share price. So of course, Prakash Pipes is something that we were tracking for quite long. So if you look at the PE ratio, so you can see the PE ratio, okay, last 1 year. So you can see the last 1 year PE ratio is always below 20. So obviously every once in a while, whenever we are looking at, trying to find new ideas, PVC pipes always would show up. But why we are recommending it today, or why we are recommending it now? There is a reason for that. For example, if you look at the share price for the last 6 months, that is from Jan. So you can see 425, 420, 400, and current share price is also somewhere around 400. So for the last 6 months, Prakash Pipes is trading more or less around the same price, 400, 420, 430 and all, same price. So it is in the range bound for last 6 months. But why we are recommending it today? For that, you need to understand what we were looking at is up until 2024 numbers. Okay, there is growth, earnings are growing, margins are pretty stable, and 2024 margins are at the peak. So we felt this might not be the right time for this stock to be recommended, because I know like 16% cannot be sustainable. So eventually the margins has to drop. So maybe during that margins drop, we'll pick it up. Generally that is what we do when there is cyclicality or the margins cannot sustain. We wait for the margins to peak out, and once the margins peak, eventually the margins will drop again. And during that phase, it's better to accumulate. And eventually in the next cycle, the margins will again improve and the net profits will grow. So I hope you understand the drill. Here, in the recent quarter, that is the very recent quarter, 2025 March quarter. First, let's look at the sales of the company. 183 crores. You compare that with the last year March numbers, 165 to 183. So sales growth is intact. So company is generating sales and they are growing also. But look at the margins. 18% was 2024 March margins. Look at the current margins. 10%. So margins have dropped. Generally, this is when we try to pick. See, what I need is a good business uh, going through some downturn, which is cyclical in nature, and you enter at that point towards the bottom. Exactly bottom you cannot identify or anyone cannot identify, but during that bottom phase, it's better to accumulate and wait for the margins to revert back. That's what happens with cyclical businesses. Margins will revert back. And in that process, the net profits will grow significantly and PE re-rating can also be done. So in that process, we might generate good returns. So that is the expectation. So here the margins dropped to 10%. So I felt okay, the downturn has started. So you can see the screen. Yeah. So first, obviously, I want to see what is the quality of the business. So as you can see, okay, this company is consistently making money, and by the way, it's a small cap company. So consistently making money, cash flow from operations, you can see, pretty good. Cash is coming into the business. So not just reporting profits, they are collecting cash also. And look at the return on equity. Return on equity is pretty solid. So high profitable business. So almost like 20, average is 22%. Last 6-7 years average is 22%. And look at the growth. Growth is also pretty good. 5 year is 27, 3 year is 21. So pretty good overall growth. Debt to equity is 0.08. So almost like very loaded company. Interest coverage ratio is also very good. Free cash flow to sales. Okay. Along with cash flow from operations, Prakash Pipes is generating free cash flows as well. So as long as, generally we look at free cash flow to sales and we generally want 5%. So here it is 5.41. So cash generating capacity is also good. So overall, the number seems really good. And current PE ratio is somewhere around 11.5. So a high quality business trading at a reasonable PE ratio is what attracted us initially. And of course, you can see these are the numbers. And you can see here consistent, except for 2024, the margins improved, but sales dropped somewhere around 5-6% drop. 5-6% drop, we cannot take it seriously because every business goes through up and down. 6% is fine. We can still consider it as a consistent sales growth company. So sales growth is consistent, but if you look at the margins are fluctuating a lot. So you can see there is a lot of fluctuation happening within the margins of the business, and the long term average is around 11%, but the current numbers are towards 13.66 and all. So 13.66 is the current margin, but if I look at the long term margin, it is somewhere around 11%. This again we are going to use in the valuation, so remember. So growth is pretty decent. Now you might be thinking why these numbers are not showing up. Like I already mentioned, this business was established, demerged in 2017. So 2011, 12 or 18, 16, 15 numbers are not available. Only from 17, and they started in 17. So we only have numbers from 2019. So all these numbers cannot be computed. So 7 year or 10 year data itself doesn't exist. So you cannot calculate 7 year or 10 year data because it doesn't exist. Only 5 year, 3 year data is available, so that we are looking at that 5 year growth or 3 year growth numbers. Okay. So seems like a high growth business. Like I said, cash flow from operations is also pretty good, and net profits and cash flow from operations narrating the same story. And cash flow from operations is the major contributor of cash. So that's where the major cash is coming from. Profitability is also pretty good, consistently more than long-term average is 25%. Return on capital employed. Return on equity is also more than 20%, which is very good. Growth is really good. Profitability is really strong. Cash flows are positive. So overall, solid. Try to understand the valuations. End of the day, even if it's a great business, we want to buy it at a great price. So Prakash Pipes, fortunately, we are getting at that great price. So that's the reason for recommendation. So as you can see, these are the current sales and all. So what are the assumptions? So last 5 years, of course, we focus mostly on the long-term growth. So last 5 years, 15% the company has generated, and there is scope for such growth in the future as well. But I want to be conservative. So the growth that I'm expecting for the next 10 years is not 15% or 12%. So overall, the next 10-year growth I'm expecting is somewhere around close to 9.5, less than 10%. I'm being extremely conservative here. That's the nature. That's the very nature of valuation. Let's be conservative. So 9% or close to 10% is very reasonable growth expectations, since the business is growing at much faster rate in the past, and there is future they are expanding the capacity. The high growth is coming from the flexible packaging, and the packaging segment is also growing rapidly. So overall there is good scope for growth, but still I am keeping it 9.5. Now the margins, the current margins are 13.66. So am I keeping the current margins, which is 13.66? No. Why? Since I have already mentioned, the margins can come down. Long term average is somewhere around 11%. So I can still keep it at 12% or 12.5%, and I can manage. Bigger than the long term growth, higher than the long term growth, slightly lower than the current margins. That I can, I can consider. Why? Because the flexible packaging is anyway going to stay and grow rapidly, right? So eventually the margins will improve. But I want to be extremely conservative here. So from the current 13.66%, what I am assuming is eventually from 13 it will move towards the 11%, which is slightly lower than the long term average. So 11 is what I am assuming as margins. And you should know I am being aggressively conservative here. I can keep it as 12 or 12.5 as well. But I'm being conservative. So, and of course, coming to sales to cap, I'm taking the current number sales to cap, and the long term average is slightly higher, 3.54. But as you can see, I'm just taking the current year's number, which I felt is reasonable. So I want to be conservative. So based on my assumptions, you can see the share price is somewhere around 400 rupees, but the value per share is 565. That turns out to be 29% margin of safety, or let's say 30, round figure, 30% margin of safety with, or 30% discount with extremely conservative assumptions. Extremely conservative. Now, I want to show you the aggressive side of the valuation also, but let's take it with a pinch of salt. If not this 10%, I can slightly improve it towards 11-12% also. And I can still manage. 11%, 12% is still a manageable target. And from 11%, I can slightly move it towards 12.5. That is also possible in the long run. And you can see, suddenly from 30% margin of safety, it is available at 43% margin of safety. But there is no point in raising the assumptions just for the sake of it. Because with conservative assumptions also I'm getting a 30% discount. So what is the point of inputting aggressive assumptions? Makes no sense, at least for me. So I'm happy with conservative assumptions giving me 30% margin of safety. So even, if you look at the reverse DCF case, even if I reduce the growth rate towards 5%, even if the margins drop towards 10%. So as you can see, even the margins drop toward 10% and the growth also drastically drop, the business is still slightly more than the share price. So downside is very limited. This business going at 5% is, that expectation itself is unreasonable. But you can see the reverse DCF. So market is being extremely pessimistic about the business. So market is thinking that this business will not grow, maybe grow at 5%, or maybe at economic growth rate, and the margins will also drop. That's what the market is expecting, but very pessimistic expectations. So this is the value of Prakash Pipes. High quality business, trading at favorable 30% at a discount to it, 30% discount to its intrinsic value. So I hope you understood why we are recommending. That's the rationale, and of course the research report also will share. Will be shared with you. So the current share price is close to 400 rupees. That's the current share price. And you can see the entry prices close to 600. So MBP is somewhere around 597, 530, 497. So that's the 1, 2, 3 phase, but the current share price is 402 rupees. So extremely, all the 1, 2, 3 phases already triggered. So trading at extremely cheap price. And of course, these are the exit prices. 820, 1100, 1300, that's the exit price. And this you will find in the research report also, which we have already shared. Today also it will be shared again. So in the Telegram channel also it will be shared, and along with this video also it will be shared with you.